We are half an hour from the open in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Paul Allen in Sydney.
And I'm Choong Wilkins in Hong Kong. Our top stories this morning. Asian stocks are under pressure after the S&P 500 falls into correction on concerns over President Trump's widening trade war. Havens are rising with gold hitting an all-time high. Trump now threatening to impose 200% tariffs on European wine and champagne after the EU's plan to tax American whiskey. Also ahead, Senate Democratic leader Chuck Schumer drops his threat to block a Republican spending bill, potentially avoiding a US shutdown. And Chinese EV battery giant CATL is set to report earnings, with investors watching for any impact from rising competition and geopolitical tensions.
All right, well, it finally happened. It was hovering around correction all week, and then the S&P got there, down 10% from the record that it set in February, Rebecca, and $5 trillion now in value wiped from that index. Gauge of mega cap tech down 2.5% on the day. Although we did hear from the former Treasury Secretary Stephen Manus saying, well, look, all this makes perfect sense. That market was fully priced. But are we seeing any signs of dip buyers yet?
Yeah, I mean, it's pretty incredible to see the change and the swift shift in narrative here. You know, there was really very little discussion around a US recession, that R word now coming up really frequently in conversations with investors, particularly over the just 24-hour period there, Paul.
Yeah, that's right. So we're down into that technical correction now. It is the first that we've seen in almost 2 years. So, yeah, we've seen havens rising off the back of that as well. We've got gold now approaching $3,000 an ounce. Avril.
Yeah, I think the mood is quite cautious in the rest of the region as we see those U.S. stock futures climbing. I think this is really related to Chuck Schumer saying that he won't block a Republican spending bill. So this paves the way for, a possible aversion of a U.S. government shutdown. But the key overhang is still policy uncertainty. And amid all this, how investors are finding it really hard to position. So it gives you the sense that whatever rebound we see, until we get policy certainty, that's going to be unsustainable. A bit of a cautious recovery you're seeing in Asia stocks as well. We are watching out for the results of a Rengo negotiation in Japan later today. This is, of course, the largest union federation in the country. Negotiations are underway and results are expected in the afternoon, possibly. Amid all this, looking at the yield on the 10-year hovering at the 4.28 as well. Let's flip the board because I wanted to give you a further sense of how much the pain in U.S. stocks and perhaps the risk-off has spread. If you take a look at this chart, it shows you how it's sort of being reflected, this trepidation in U.S. high yields as well. It had the worst months in more than 2 years. And the question now becomes, with investors seeing these asset losses, is there a negative wealth effect? Does that constrain their spending? Then we see knock-on effects on the American economy. So the board, because all of this week we've been seeing that negative correlation between US and Chinese stocks, that relationship being put to the test. Indeed, as U.S. stocks struggle, so has the Hang Seng. We're pointing to some gains at the open. We're seeing that pressure that has been coming for Chinese bonds that eased off a few days ago, maybe coming back a bit, a continued slide potentially on the renminbi. Now, on Chinese stocks, maybe there are some encouraging signs. We had Securities Daily suggesting that based on a CICC report, that foreign fund inflows are accelerating because of AI optimism.
Thanks, April. And just picking up on your point there about that negative correlation, very much in focus today when we're eyeing what to look out for. Hong Kong stocks are on track for we've had 5 days of losses. Potentially, we're going to see a 6th day now. And that is partly down to this story about Hong Kong volumes that we've seen. Historically, we did actually see a lot of support coming through that southbound channel. In fact, we had the second highest on record just earlier this week. But it's really whiplash between really thin volumes and really robust volumes. So yesterday was 48% lower than the 20-day average for Thursday, for example. We also have some hedge funds reducing risk, primarily in reducing their China exposure for EM in Asia. Elsewhere, just keeping an eye on this CGB sale, the biggest ever for a 2-year, as well as a host of earnings. And we are, of course, still in the window for some of that credit and FDI data.
All right, Bloomberg MLive strategist Mark Cranfield joins us now to discuss some of the market action that we've seen. And Mark, got to start with that correction that we've seen on the S&P. It's been coming all week. It's finally arrived. But where are the dip buyers here? Is this market looking oversold, or is there potentially some more to come?
It wouldn't be at all surprising if some people have been targeting a 10% area for them to start to put some money back into the market. That's pretty normal. You would see that in any major market. There's always some investors who've got cash to put to work, and they will target specific areas like that. Unfortunately, it's not really going to change the picture too much in the near term. The reasons why people have been so cautious and worried about the US market are still very much in place. And you can see, once again, Donald Trump is having yet another fight with the European Union over tariffs. He's now threatening to put 200% tariffs on certain products in Europe, particularly in the wine and champagne area. Now, that kind of thing, that tit for tat, that back and forth between the US and other countries, tariffs going up and then being increased and then going again, that is the kind of thing that is really hurting sentiment in the equity market. That's why traders and investors are very concerned and don't want to commit too much long-term money. So we may see a bit of a knee-jerk bounce today in US equities because it hit that 10% area. That doesn't really tell us very much about where it's going in the medium term. Indeed, I mean, for now, people are going to remain very defensive when they know that there's no end in sight to the trade war. And on top of that as well, the geopolitical situation isn't looking that much brighter. Russia so far is not agreeing to a clear truce and ceasefire against Ukraine. They want more time to consider it and put their own factors into play there. So that all of the things which have been worrying people from the past couple of months are still there, and they don't look as though they're going to improve in the near term. You've got a Federal Reserve meeting next week. They're unlikely to sound as though they want to do anything to help the market for the time being. They're happy being on hold. They want to see more data coming through. So there's really no encouragement for investors to put a lot of cash to work in US equities for the time being.
Mark, tell us how the weakness in US markets is spilling over into Chinese assets and stocks in Hong Kong. Of course, it has been somewhat of a story of resilience that we've discussed, partly because of that offset for DeepSeek. But, you know, through this week, for example, Hang Seng down for 5 straight sessions. What should we be expecting here?
I think you've seen an understandable retracement in Hong Kong. It had such a flying start to the year. That's not a huge surprise. There is a bit of a decoupling story going on. People are looking at the Greater China area, particularly because of the AI story, as you mentioned there. It does, if you speak to investors around the region and even from outside Asia, they're clearly very excited about the possibility that there are Chinese companies who will be able to compete with the big US tech firms because they've got access to a cheaper AI story here. So that's probably got some legs. We've seen money come in. We've seen a very good start to the year. The important period now is the consolidation, making sure that most of that money stays in place. The way that the trading volumes have gone this week, it doesn't suggest that much money has backed out. The volume's a bit more subdued. It suggests there's always some hot money which comes and goes quickly from markets, but that's only a small percentage. It looks as though most of the people who've committed to being into Chinese tech stocks especially are still there. We've got a big test next week. Tencent will have its earnings. That will be a good way for people to see whether or not they still believe in this story. But certainly there's a reasonable amount of traction in the idea that Chinese tech stocks especially can diverge from the US. And as you say, the yuan is pretty stable. PBOC has done a good job of keeping the currency fairly calm. At the same time, they're getting some help from the fact that the US dollar is a bit softer as well. So people don't need to worry so much about the currency. You can see the Hong Kong dollar is benefiting as well from the inflows that are coming, and it's pretty strong, getting towards the stronger end of its band there. So all the background factors are relatively good, but it will still need the Chinese authorities to continue to tell everybody that they're doing more to support the economy. The PBOC will probably still need to lower interest rates again this year. Those things need to be in place. But for now, certainly the divergent story has some legs, and it can probably go further.
All right, Bloomberg MLive strategist Mark Cranfield there. Well, President Trump is threatening to impose a 200% tariff on European alcohol, and that's after the European Union's plan to tax American whiskey exports. The bloc's top diplomats say they don't want a trade war, but will not hesitate to defend their interests.
We are not interested in trade wars. There are no winners in trade wars. Who is laughing on the side or looking at the side is China, who is really benefiting from, U.S. having a trade war with Europe. But it is also clear that if these tariffs are put on us, then we are also defending our interests.
Let's bring in Bloomberg desk editor Jill Desis. The very latest on tariffs. How are we seeing this sort of spiraling out and spreading?
Well, I think at this point, you can kind of see how almost emotional the reaction has really gotten when it comes to this relationship between the U.S. and the EU. You had Trump's Commerce Secretary Howard Lutnick just say that Trump was totally annoyed by these latest tariff threats from the EU on American whiskey. That's, kind of saying, why are they, impacting Kentucky bourbon and Harley Davidsons and all these things of American culture. I mean, at this point, it does seem like it's both the EU and Canada really that have kind of come out swinging when it comes to putting in place, either these sort of retaliatory measures here. Trump at this point has said that he does plan on retaliating further. Obviously, we've heard that 200% tariff on EU wine, on champagne. He's even said, something along the lines of, we'll just we'll make our own like American champagne. So, I mean, you can kind of see how this is spiraling. I mean, look, Rebecca, at this point, I think we're all kind of looking at that April 2nd retaliatory deadline for tariffs that Trump has put in place. It's sort of looking globally at how these countries are going to be impacted. Unless there's deals brokered before then, it does seem like it's going to continue to escalate.
Jill, where is China in all of this? Because we did just hear from the EU's Kaja there saying, look, China must be laughing. Comparatively speaking, got off very lightly. Is China's turn coming, or is this going to be strictly limited to allies and the US at this trade war?
I mean, Paul, that's really been the big question, I think, throughout the entirety of Trump's first couple of months in office. So we saw some tariffs that have been put on China. There was a 10% levy. We saw that doubled. I mean, there's some things that are in place here, but obviously nothing to the extent that we've seen impact, nations like the EU, Mexico, Canada. I mean, these major U.S. allies here. So I think that is pretty remarkable. I think there's something to be said. Some may argue that in sort of, implementing those tariffs, maybe there's some indirect effects that the U.S. is hoping that will have on China, particularly as it kind of pressures some of its allies to implement higher tariffs on Chinese goods. A lot of that kind of comes down to, these efforts to either protect national security or sort of limit China's ability to develop, higher-end technology. We have seen some measured responses from China on some of the measures that America has taken, whether that be probing American companies, whether that be, sort of responding with retaliatory efforts on things like American soybeans. But yes, it really hasn't escalated a lot. Although, in some ways, sometimes, China's kind of strategy is to lie low a little bit, just put out, some measures. Yeah, I mean, it's very true, though, that they haven't gotten sort of, wrapped up in the escalation to the effect that some of these American allies have. Will that change? I think that's, really something that we'll just have to see develop over the course of the year.
Okay, Bloomberg Asia Desk Editor Jill Deesis there. And still ahead, we'll be hearing from UBS Investment Bank after Beijing announced plans to recapitalise several of its biggest banks in the coming months. But first, Fudan University joins us with their take on what lies ahead for the Chinese economy amid that ongoing trade war with the US. And of course, we are counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. A very good morning to you and happy Friday. This is The China Show. A very good morning to you. Welcome back. You're watching The China Show. Now, top of mind, a big story for us today, of course, has been the tariff story. It's played out overnight in the US. Let's bring in Qian, Professor of Finance and Executive Dean of International School of Finance at Fudan University. I mean, we have to start with tariffs, I think, partly because of what we've seen overnight in the US. Really, US markets starting to reckon with the full reality. There have been some economists that have warned that more risky to China than just US tariffs is this cascade effect of tariffs from other countries, the likes of Vietnam, South Korea, Canada. How do you kind of weigh those two factors up?
So certainly China, number one, is the biggest country in terms of trade with a lot of other countries. So I think direct trade with the U.S. will be affected if there's a lot of tariff coming this way. But on the other hand, I think China's export structure has been diversified a lot over the last 6-7 years. So right now, what you're seeing is that if the U.S. imposes tariffs on other economies, I think the net effect is that the U.S. will be affected the most because essentially they are raising the prices for everything imported into the U.S. So for China, I think the key is there will be a negative hit if there's a significant contraction of the direct trade with the U.S. But other than that, I think it's going to absorb the hit well enough because of the already very diversified export structure.
So if China is effectively managing the dent that we see now, so we see this additional 20%, that takes us to about 30% of US tariffs on Chinese goods. At what point do tariffs start to bite?
You know, people have done all these calculations. If it goes all the way up to 50% or 60%, there will be a negative impact on the Chinese economy, again, because of the direct trade. But, you know, right now, there's so much uncertainty going on, and the U.S., they're feeling the negative effects. So really, it's not clear to me whether the U.S. administration, how much they're willing to let the U.S. economy and consumers take a hit. So frankly speaking, I think it's a waiting game. I think the China response, I think it's appropriate. You have to respond, but it's not a very aggressive response because China doesn't want to escalate this on China's end. So as you can see, there's so much uncertainties with the tariffs, with the implementation of the tariffs, with the industries, regions that the U.S. Equity markets, for example, inflation, all these uncertainties are coming back. So we'll see. We'll see what the Fed will do. It's not clear to me which side, U.S. or China, will be hit more.
I want to pick up on your point here about Beijing's response. It has been really quite surgical, very restrained, very measured. And in some ways, that's made it hard to understand what a more significant response, a more aggressive or robust response will look like. What should we be watching for? Because we have had some of these quite pointed comments from Wang Wentao, from the Ministry of Commerce and so on. What kind of response should we be looking for from Beijing that would suggest perhaps a shift?
I think that, because China's export structure is so diversified, and the other point that's very important is the opportunities with non-U.S. regions, for example, with the EU. So I really think they're doing the right thing. I mean, Of course, between U.S. and China, because China still has a very big surplus against the U.S., so in terms of direct trade relations, there's only this much China can do. The important thing is what the U.S. will do, whether it will impose tariffs on other countries, especially other countries that also have a large has a surplus with the U.S., like Vietnam and other countries. If there's tariff on these other Asian economies, for example, I think the effect on the U.S. side will be very significant. So that's what I'm saying. I think if I were the Chinese government, if I were the policymakers, I would respond. But really, it's a waiting game. And the other thing, of course, we hope there's going to be more dialogue, especially at the top between the leaders. And so hopefully they'll understand that this is not a win-win situation.
Professor, is there another path here as well? We heard from the former Australian Prime Minister Malcolm Turnbull earlier this week saying, look, China can just present itself as the anti-Trump, as a beacon of stability in a chaotic world. And in that respect, is there an opportunity here to push some tariff-free trading blocs like RCEP? And is there a chance for China to pursue its membership of the CPTPP?
I think there is. So as I said, that big opportunities exist between China and EU. And also, over the last few years, the biggest trading partner for China is the ASEAN, Southeast Asian economies. There's more integration in this region. And as you said, China wants to join the CPTPP because it wants to show the world that it wants to take the standards from these very high standards and remain opening up to the world. So indeed, there will be opportunities, and especially, and that's in very sharp contrast with the U.S. because, as I said, there's so much uncertainty, even with the tariffs, like in which regions, in what products, and so much back and forth. So compared to that, again, it appears that the Chinese response has been pretty clear, very transparent, and as it says, it wants to remain open to the world.
Professor, thank you so much for joining us in the Hong Kong studio. Excellent to have you here in person. That was Choong, Professor of Finance and Executive Dean of International School of Finance at Fudan University. There's plenty more ahead. You're watching The China Show. Stay with us. This is Bloomberg. Good morning and welcome back. We're about 3 minutes off and change for the Open. Just a quick look as we head into today. And it does look like we are perhaps seeing a little bit of optimism returning back after this losing streak that we've seen in Hong Kong. The Hang Seng up about 0.8% there. And if we can just flick the boards, also looking at this corporate story today, Budweiser up about 1.4%. It's making more job cuts this year. That follows the stream of job cuts that we've seen over the past few years at the firm. Stay with us. This is Bloomberg. Good morning and welcome back. You're watching The China Show. We are counting down to the open of markets and seeing a little bit of positive momentum, just a touch coming back into the markets. We're still higher, about 0.8% there on the Hang Seng. But we've seen this sort of lackluster demand followed by really robust demand supported by those southbound flows. So watch closely to see whether investors are looking at an opportunity perhaps to buy the dip to come back here. And let's check in on the China Open with Avril. Avril, take us away.
Yeah, Rebecca, I think it's really a question of after a pretty choppy week. I mean, we've seen a mixed performance on the CSI 300 for all of this week. Do they get the Friday feeling? And at the open, it looks like we were pointing to a positive start, a bit of a brighter start to the trading session. And amid all this, it is really, the idea of whether we see that continued US-China stock divergence, that relationship that's been tested for all of this week, a bit of a recovery. A little bit on these Chinese bonds, actually pretty mixed if you look at the long end of the curve. A couple of stocks that we are watching is earnings related. CATL that has been trailing its EV battery making peers. Record profits expected even in the face of weak demand. That's one stock we're going to be keeping an eye on. AIA, after missing for the full year and new business results, it did announce a share buyback. So among the stocks we're watching as well. Other than that, it's really if we can flip the board, take a look at what we're seeing in the Hong Kong markets too, where, if you look at the mainland performance on the CSI 300, is really how the energy stocks have actually been the worst performer so far this year after outperforming for the past 4 years. So a lot of this is AI optimism driven, and today it looks like a bright start for these Chinese consumer tech related names. We're also keeping a close watch on the stock of Xiaomi. Earnings are due next week, and it's a stock that's kind of been priced to near perfection. It's benefited from the duplication, being able to show that it's successful in not just its smartphone business, but also in the EV game. And as its results are due next week, and is going to be unveiling SUV model, electric one, we're going to be watching very closely if it meets some of these investor demands. But as I say, Chinese tech is supportive of the Hang Seng today, so we're seeing maybe a bright Friday. Rebecca.
Yeah, that's right, Averill. That 10-cent earnings coming up next week, an important test for markets. Averill, thank you so much for joining us. Now, looking at the Chinese banking sector, China's dividend-paying banking stocks are among investor favourites in Chinese equities. That was until we saw this deep-seek-fueled rally in AI-related stocks. But UBS thinks US trade uncertainties may still help the sector outperform. Joining us now is May Yan, Head of Asia Financials Research at UBS Investment Bank. Let's begin on that theme, first of all. The risk of tariffs and how that impacts the Chinese banking sector, particularly, of course, because we have this big spread of tariff news coming through today, a lot of tit-for-tat tariffs potentially elsewhere in the world.
Yes. It will impact the Chinese banks through macro. So if it brings down China's GDP growth, for example, China's economic recovery, of course, it will be negative for the Chinese banking sector's asset quality as well as net interest margin. But I think to a large extent that has already well known since late last year of threatening of potentially 60% tariff on all Chinese goods. But so far, it happens about 20%. So the market feels like, okay, maybe the U.S. President Trump has not so far singled out China. So the pressure is less. That's why China market and also Chinese banks have rallied quite a lot this year to date.
Okay, and we are coming into earnings seasons. You've adjusted some of your estimates. We've also noted that net profits after tax for both the 4 joint stock and the 12 regional banks up loads double digits there. What are you expecting? What are the highlights we should be looking out for from earnings?
Actually, we had about 16 listed banks have announced the preliminary results, and those results shows that there have been some improvement in the fourth quarter in terms of revenue and pre-provision profit as well as after-tax profit. So I think the fourth quarter was a lift to the full-year results. So the results would be in line or better than expected last year. But I think investors will be checking on the outlook for this year at the earnings conference, particularly interest rate, on the net interest margin, and etc.
May, when do you potentially see the next round of bank deposit rate cuts for customers as well? Because we've got some banks now with a long-term deposit rate below short-term savings. How sustainable is this? What do you see happening next?
Yeah, bank net interest margin has been under quite a lot of pressure. Say, for example, in the last 3 years, they've gone down from 2.1, 2.2% to 1.4, 1.5% only. So that had a lot of sort of pressure and negative impact on the bank's revenue and profits. So in line with that, I think the central bank has been more aggressive in cutting deposit rates. Going forward, I think that will happen too. But of course, it depends on how much rate expectation, how much rate cut there will be. So, our house view is 30 to 40 basis point rate cut on the policy rate this year. So that may translate into a sort of measurable, similar magnitude of deposit rate cut. So it will happen.
Yeah. And is it possible to accurately quantify banks' exposure to property developers as well, or are there still some unknown risks out there?
That has also been well analyzed. We estimated potentially there could be up to $2.5 trillion of losses on the banks from the suspended projects, developer loans, as well as a little bit of the shadow banking and also mortgage side. But it seems like things have been improving. First, from the potentially stabilization of property sales this year in China. And we also seen about 40% of completion of suspended project by the end of last year. That's a significant progress in resolving these losses for the banks as well as social issues. Of course, there's still about more than 3.7 or 3 million units that have not been completed that needs to be done in the next few years.
May, I noticed a sort of slightly better than expected in terms of that property hit to banks. But, of course, margins are still tight. They have been so squeezed as a result of the real estate crisis. What is it actually going to take to try and improve the sort of fragile environment for Chinese banks? And how are you factoring the recapitalization plans into that?
Yeah. As you pointed out, it's also the top concern and issue on the investor minds of this capital injection, and why is it happening, and what's the purpose of that, right? I think it's more like a compensation for the banks after their last couple of years margin compression, decline in revenue, and maybe flattish net profit. So they haven't had enough organic capital growth. So that's why they need some external help from other sources like central government. So I think it helps with the financial system stability with that, and also going forward they can continue to lend, but not maybe as aggressive as during the COVID time. It will slow down to like 7 to 8% loan growth.
Okay. And you're just coming back from a trip from the US. I want to ask, give us a little bit of colour from what you're hearing from your clients. Are you seeing the attitude shift? And how are you making the sell, the deep-seek optimism versus what we're seeing in this sector? Yes.
I met with more than 30 large institutional investors, and I felt I guess it's a bit lukewarm toward investing into China, because this uninvestable talk in the past versus now. I think they are interested in China names. Of course, the top focus would be on AI, on internet, on tech, etc. For China banks, there's some private banking clients that are interested because of the stability of the stock price and also the dividend. But if anybody investing into China banks, it's because they wanted to get some more macro exposure to China, and the banks would be very liquid and good entry point for them. So we saw some moderate increase maybe into the Chinese bank stocks, but to convince the really long-only clients to come into China banks and China market for long haul, long time, I think it still takes some time.
Okay. Yeah. And what do you think it's going to take in terms of what we need to see from the economy? And I guess to what extent is the deep-seek optimism, is that helping to drive at least the broader gauge of sentiment here?
Yeah, I think investors felt this deep-seek-led rally for China market is more sustainable, it's more solid than the last September's macro top-down or stimulus-driven rally. So this is more grassroots. It shows the innovation, the entrepreneurship in the China's private sector is still very vibrant. So they are more convinced for that, but more thematic rather than broad China everything. So I think it still needs the economic recovery to really coming back, and China's maybe get somehow bottoming out of this property down cycle, the local government issue, all these consumption weakness and etc. So in other words, the broader macro improvement will come in soon.
I mean, that's a really good point there on needing to see this bottoming out. I just want to ask, on NPLs, what are you seeing? Are we now reaching, have we seen the highest level of stress here?
I think on the property sector and local government concerns, yes, those NPLs are probably reaching a bottom. Whether it's going to, the cycle will turn to improve, I mean, it's yet to be seen. But on the other, there's some other issues of overcapacity, manufacturing sector, et cetera, is still developing. But overall, I think the probably will reach the bottom for the NPL issue.
Okay, May, thank you so much for joining us today. That's May Yan, Head of Asia Financials Research at UBS Investment Bank. And now a quick look of a stock in focus today, CK Hutchison. So CK Hutchison falling as much as 6.7% in Hong Kong after we had this rebuke from China. So this essentially was a column in a Chinese newspaper criticising that CK Hutchison port deal. We'll have more on that story ahead. Stay with us. You're watching The China Show. This is Bloomberg.
Welcome back. Here are some of the top corporate stories that we're following. Alibaba has unveiled a new version of its AI assistant mobile app, Quark, which incorporates its latest in-house reasoning model. It now integrates functions including a chatbot and task execution. New Quark will be available to all users gradually, starting with a pilot launched on Thursday. World Liberty Financial, one of the Trump family's crypto ventures, is said to be in discussions with Binance about doing business. Sources say conversations have included the development of a stable coin with World Liberty. According to its founding documents, the Trumps receive 3/4 of the venture's net revenue. Tesla warned the US government that retaliatory moves by other countries could drive up costs and make its cars less competitive. It expressed concern about tariffs' impact on its supply chain. In fact, Canada's third most populous province, British Columbia, pulled government subsidies for people to install Tesla chargers. British Columbian Premier David Eby said the move is targeted at Tesla CEO Elon Musk, who is one of Trump's biggest backers. AIA will start a $1.6 billion share buyback, which its CFO says reflects strong momentum in the business. Garth Jones spoke with us earlier.
We saw an excellent set of results by any measure in 2024. We saw double-digit growth in our key metrics for new business growth, for earnings, and for cash generation. Our value of new business, our key growth measure, grew by 18%. And importantly, we had double-digit growth across all our market segments. It's a broad-based growth. Our operating profit after tax was up 12% per share, and our underlying free surplus generation also grew by double digits. So with that, we've seen an increase in the final dividend of 10% per share, and as the headline says, a $1.6 billion additional share buyback. I think that reflects the strong momentum in the business. We've seen growth across the portfolio. We've seen recruitment be very strong in the agency force. Recruitment was up by 18% in 2024. And with that, we see the strong momentum building into 2025. So we remain confident in the outlook. And we're very well placed to capitalize on all the opportunities available to us.
Can you tell us about how the China part of the business is going, how margin expansion is looking? Last year was pretty good, and what sort of expansion and strategic plans do you see for China?
Yeah, we're obviously very excited about our China business, which goes from strength to strength. We have a differentiated business in China, which is focused on the wealthiest parts of the geography, the biggest cities in China, and also the wealthiest segments, the more affluent customers. That makes them more resilient through economic cycles. Our business is also very well diversified. More than half our earnings come from insurance and fee-based sources, and our business is focused both on protection and long-term savings. So what we've seen is growth in the agency force again. The agency grew, recruitment has been strong. We've seen growth in the number of new customers, and the business is going from strength to strength over time. Importantly, we've also seen growth in our geography. We started off with our original 5 geographies, which continue to grow, and we've deepened our presence there. We had 5 new geographies from 2019. They've been growing very well. They grew at 27%. The business overall grew by 20%, so you can see they're growing even faster than the rest of the portfolio there. And our new businesses in the provinces we've just been awarded. We were awarded 4 new provinces in 2024, and we're just starting operations there. So you can see there's tremendous headroom for growth in China. We remain extremely excited about the prospects there.
Garth Jones there, Group CFO for AIA. Now, if you're a Bloomberg subscriber, you can catch up with all our interviews by using our interactive function, TV Go. You can also join the conversation by sending instant messages to our team and our guests during our live shows. You can check it out at TV Go. Plenty more ahead. This is Bloomberg.
Good morning and welcome back. You're watching The China Show. Now, Portugal will hold an early election on May 18th after the government was ousted in a confidence vote. The collapse may delay some key decisions, including infrastructure investment and defence spending. This will be the country's 3rd election in just 3 years. The Prime Minister is expected to seek re-election. Former Philippine President Rodrigo Duterte is set to appear before the International Criminal Court later today. On Friday, Duterte is facing charges for alleged crimes against humanity during his deadly war on drugs. His arrest marks a significant milestone for the ICC and a major political shift in the Philippines, where his daughter is vice president and the Duterte clan enjoys strong support in the South. U.S. Senate Democratic leader Chuck Schumer is dropping his threat to block a Republican spending bill. The move opens the way to avoid a U.S. government shutdown on Saturday. Democrats and Republicans have been engaged in a standoff over Democratic insistence that a spending package includes some restraints on Elon Musk's federal cost-cutting crusade. And sticking with the US, where Commerce Secretary Howard Lutnick is praising the UK and Mexico for refraining against engaging in tit-for-tat tariff hikes with Washington. Speaking with Bloomberg, he's blasted Canada's retaliatory tariff moves, accusing the government of doing it out of domestic political interests.
Take a step back. National security, we put a tariff on steel and aluminum to make sure the dumping countries of the world stop and we can build up our steel and aluminum in America. And what does Canada do? They put a tariff on sports equipment. I mean, really, this is just, it's tone deaf. Listen to the president. National security matters when he calls out things like semiconductors. He calls out pharmaceuticals. He calls out autos. These are things that matter to us as a country. And if you're going to respond to us with sports equipment, you're just not listening to President Trump.
Secretary Lutnick, how much are the conversations today actually about bringing up the negotiations when it comes to USMCA?
Well, USMCA, we set aside USMCA. So the United States made a deal with both Mexico and Canada that said if you have enough U.S. content in certain products or it's actually made domestically, they can trade between our countries tax-free. That remains intact. What is outside of that is both things that don't have that American content that are imported from other countries. So that has a tariff on it. And now the president has said, look, there are certain topics I need to have us make in America. And steel and aluminum is key. I mean, we all understand that. So why not allow the greatest country in the world, who completely feeds Canada? Canada exists, completely feeds off of the amazing economy of the United States of America. Let us build up our steel and aluminum so that we can protect ourselves. And by the way, we protect Canada. I think Canada's got 60 planes. Oh yeah, they're really going to protect themselves. They're the lowest investor in NATO. They totally rely on us, and yet they think they need to respond to steel and aluminum tariffs. I mean, everybody is so used to picking off America, so used to it that they can't even stop. Donald Trump is here to say we need to be treated fairly, and we need to be treated fairly now.
US Commerce Secretary Howard Lutnick there, speaking with Bloomberg's Anne-Marie Hordern. Let's get another check of the markets now. I'll tell you what's good for markets, babies, particularly when it comes to China. We did, of course, have the news that Hohhot, a city in China's Inner Mongolia autonomous regions, introduced a one-time subsidy of 10,000 yuan for couples having their first child. Well, that's led to some speculation that we might see other local governments follow suit. That's according to city analysts. So we're seeing some of those baby stock names, food providers, kids wear, doing pretty well in China at the moment. What else is doing well is gold really catching a bid, particularly after the S&P ended correction. All that trade tariff uncertainty, it's driving gold stocks higher, and gold closing in on that $3,000 an ounce threshold. Earlier this week, Macquarie Group forecast that we could see $3,500 an ounce in the second quarter. So that haven trade still very popular. China benchmarks, meanwhile, looking like a pretty positive day at the moment. The Hang Seng Index also better by about 0.9%. It's not been a great week for the Hang Seng, comparatively speaking, but all in the green right now, which stands in stark contrast to what we saw in the US today. More on the way in the next hour. You're watching The China Show. Welcome back to The China Show. Let's take a look at how the Hang Seng is doing about half an hour into the session so far. Pretty well is the answer. The Hang Seng had logged 5 consecutive losing sessions. Looks like we're going to break that streak today, performing particularly well. The consumer discretionary stocks up better than 2.2% at the moment. Well, let's check in on some of the other movers in China markets with Avril Hong. Avril.
Yeah, the couple of stocks that we are keeping a close watch on include CATL. Of course, this is an EV battery maker that has been languishing versus its peers, but record profits are expected. So maybe that optimism being reflected in the price action. But going the other direction, AIA, it missed on full year as well as new businesses. So the share buyback not quite being enough to lift the stock. Baidu reportedly with a tie-up to help improve its advanced driver assistance system with Tesla, and that's among the stocks that are surging, among the Chinese tech names that are doing well today. And of course, CK Hutchison as well, after China amplified its rebuke of Li Ka-shing's port deal with BlackRock, sinking about 6% today. Flip the board, let's take a broader look. You talked about the Hang Seng. Maybe today is the day where it snaps its long losing streak, but also note that when it comes to mainland stocks, the CSI 300 sub-gauge is really interesting to see how the energy sub-gauge has been the worst performer so far this year after 4 years of taking the top spot. So it's really fallen victim to this rotation towards growth stocks. We're seeing quite stable on the renminbi as well. Probably comes as a relief to the PBOC.
Avril, thanks very much. And thinking about some of that resilience that we're seeing coming back into Chinese markets today, let's bring in William Ma, founder and CIO at Grow Investment Group. Let's start on that theme of resilience, and let's think about A shares and H shares separately here. But, you know, what kind of momentum do you think we're seeing behind the rebound, and can it be sustained in light of some of this weakness we're seeing in US markets?
Yes, thanks for having me. You know, I'm glad here today because the market is up. We are very positive on the A share and H shares market because we see actually the rotation is there. And fundamentally, if you look at some of the domestic hedge fund and sentiment, we are seeing them increasing exposure as well. You know, for us, we are estimating the China A share to have 20 to 25% upside for this year, on which 10 to 15% is the earnings. The rest is the multiple expansion. So this is just the beginning.
Your point there on the sort of domestic support is important, of course. We've seen these really robust southbound flows. As we see that flow come back in, how are you shifting your strategy when it comes to A shares?
Yes, we are adding both A and H shares, but we are very positive on the China so-called alternative investment space because I think a lot of people are talking about the long-only and beta space. But what is missing the picture, if you like, is China, in fact, is a huge alternative investment market. To put some number into perspective, the alternative or the hedge fund plus private equity market, we are talking about $3 trillion of size. The mutual fund is 4.5 trillion. But compared to the US, the alternative investment is 10% of the mutual fund size. And some of the alternative investment strategy year to date, they're up between 10 to 15% when the market is flat. So when there is more action, basically you get both the alpha and then the beta of the story.
William, are you able to share some names or some ideas on that alternative investment front?
Yes, you know, on the alternative investment fund, I'll give you two examples. One is the convertible bond trading strategy. You know, in global, you see, you know, we have, you know, Black-Scholes model to do a convertible bond pricing. But in China, because of there is a lot of retail investment, if you like, you know, basically they are trading your convertible bond like stocks. But if you put on a Black-Scholes model into the pricing, you can, you know, calculate and strip out the outperformance of the call or put option, if you like. This is one strategy. The other one is we have some fundamental strategy. We have some limit up, limit down strategy. When the China A shares turnover is increased by 2 to 3 times, actually those strategy has performed, you know, very well. It's not just the quant market neutral people, you know, talk about usually.
How's your exposure to China domestic consumer discretionary stocks at the moment? And I'm really asking, how convinced are you by the MPC commitment to boost domestic consumption?
Yes, you know, our investment theme for this year is BAT, and then I'll start with the consumption. I think consumption is a really powerful theme, if you like, but having said that, we believe we see more opportunity on the T side, which is, you know, tier one or global number one players, you know, guys like Ninebot, you know, the electric scooters, you know, player, Meidi, and then, you know, kind of like the largest white goods manufacturer, and then also kind of like the soy sauce manufacturer, Haitan. On the consumption part, I think we have to be careful. The top line, we expect there will be increasing, but we are talking about because of the consumption, you know, so-called downgrade, we believe the margin could be compressed, if you like. For some example, like Qingdao, you know, the brewery manufacturer, I think the net margin is 13%. Having said that, if there are more policy stimulus, the top line could increase, but I little bit worried about the margin, whether it's sustainable or not. So for us, we are looking for more global tier one player in which they are not just focusing on the domestic market. And let me give you one example. You know, for example, Meidi, 40% of their earnings is from global, 20% is from US, 10% is from Africa. So those players is domestic consumption plus global expansion, which is, you know, one of our favorite, you know, stock, if you like.
William, your point here on a little bit of concern when it comes to consumption, or a little bit of wariness, is really important because actually this has been such a momentum-driven market.
Yes.
But DeepSeek has changed that. It has been a watershed moment.
Yes.
And I want to ask what you're hearing from your clients. I mean, you have a majority of mainland clients. You have this window into sentiment.
Yes.
Are we still in that phase of a momentum-driven market? Does what Beijing says really matter now? Or have markets taken their own momentum, their own narrative?
Well, it's more than the momentum. Seeing is is believing. When you see the eyes of entrepreneur, you see the lights, from them again. Last time I saw it was before COVID. That's why I spend most of my time in Shanghai. A couple of reasons. One is, I think, as Joe Tsai mentioned, a lot of global market investors, they did not realize how important is, President Xi, seeing, Jack Ma. So the private investor or the private entrepreneur, they start investing again. And the DeepSeek, I think eventually it will generate into earnings. Some of our clients, they are the mid-cap business owner, and then they are now using DeepSeek to improve their SaaS, SaaS program, and they are hiring and spending. So those are leading indicator that as a fund manager, we are watching instead of the behind the scene, kind of like the share price, if you like. So I think DeepSeek both changed the earnings pattern and then the CapEx, program, as well as the sentiment from the fund manager.
Okay, so when you're seeing the light come back into private enterprise, what are the sort of names, what are the sectors, industries that you're liking? Anything new that's emerging in your strategies?
Yes, besides, I think the T is the one that we like, meaning global tier one or global number one. For example, Haitan, I mentioned, they are the largest soy sauce manufacturer in China, but their overseas contribution is just 5%. Look at Kinkoman in Japan, 72% of their sales is global. So they are growing more global. Nine Bots, they're more global. Meidi, is a global tier, good player. And then secondly, I think people also underestimate the power of Baidu. If you look at last time when Baidu, the market cap overtake Maotai, it was like back in October, 2021. But right now, Alibaba overtake Maotai market cap again. So I think Alibaba would become kind of like the go-to place for global investor and Chinese investor investing in the technology and AI, and it would kind of trading like NVIDIA. It would kind of like trading in Maotai in the back old days. So for us, BAT strategy is Alibaba, and then alternative investment like Kopfer, we mentioned yesterday, the China Overseas Hedge Fund Association, alternative investment. And then T is the tier one or global number one Chinese companies.
William, I just want to get your thoughts as well on the current trade and tariff environment, because so far it's Europe and US allies that have really felt the pain from US tariffs, China less so. But how do you evaluate that potentially changing down the track? What's your outlook for China's exporters?
Yeah, it's a tough one, to be honest, Paul. I think it would be really risk on and risk off. And I'll put some number into perspective. One of the largest sovereign fund in the world in Europe, they put out a stress test, if you like. They expect their portfolio would be down 18%, because of the AI correction. They expect the portfolio would down 40% for debt crisis. But for the geopolitics, or tariff, they would down 35%. So I think a lot of the global institutional investor is pricing in this kind of risk in the market. And for us, that's why if you look at our portfolio, we are quite shying away from the global export play in the China market, because I believe it would be headline risk and it would drive, on and off. That's why compared to H shares, we are more positive on A shares because it's less driven by this global risk-on, risk-off environment.
What do you think that global institutional investors, who are still really quite hesitant on this market, particularly on the US side, what are they getting wrong about China markets?
Yes and no. On paper, when I talked to the CIO of the pension fund, US and Europe, they said, William, no China, no China. But actually, some of them already investing China through their EM portfolio. And secondly, some of the biggest wealth management company before NPC, if you look at, it's all public information, they reduced their US allocation by 1.5% and then they invest in China by 1.5%. For them, it's a long cycle, so I believe the action is there. Last but not least, I think Middle East capital is going to be very big in the China-Asian market. There is something, to be watched for.
William, absolute pleasure to have you as always. Hope to see you again soon. That's William Ma, founder and CIO at Grow Investment Group. Now, still ahead on the China show, why startup Manus AI is seen pushing the country's DeepSeek moment further. We take a look at what it can do and what lessons it holds for Silicon Valley later on today. This is Bloomberg. You're watching the China show.
Russian President Vladimir Putin says he wants to discuss the proposed Ukraine ceasefire with his US counterpart Donald Trump, but he says any truce should lead to a long-term resolution of the war. Trump is optimistic of a ceasefire, but says that doesn't mean anything until the final outcome is known. The European Union says what happens next to the US-brokered truce between Ukraine and Russia depends on Putin. The bloc's foreign policy chief, Kallas, says Moscow should also show some goodwill.
The ball is in Russia's court, and of course we are all very much looking forward to how they react. Either they say yes with no conditions, no with no conditions, or yes with conditions. I would bet on the yes with conditions, and then the question is, what are these conditions? What we heard from the media, these conditions are, of course, not acceptable. I mean, that there would be no military aid to Ukraine. I think there was something else. It's not the conditions that we can live with.
Have you been briefed directly by the Secretary of State, by Marco Rubio, about conversations that are taking place in Russia between Steve Witkoff, the president's envoy, and President Putin and his team?
Yes. Secretary of State Marco Rubio briefed us what was the case in Saudi Arabia. Witkoff is traveling to Moscow and the talks there. So yes, they're keeping us informed, and also promised to not agree to any conditions that we wouldn't agree. That we definitely have to talk to each other before anything moves forward further.
Is there any update on what European nations want? That is the security guarantee for Ukraine. And if they aren't in place, do you have much faith or confidence that Russia would uphold its end of the deal if, in fact, there is one?
Well, that is always the question, because we have seen the ceasefires before, and Russia has never kept to those agreements. So that's why I think the best security guarantee, or the first security guarantee that there is a strong Ukrainian army. That's why we are also arming and helping Ukraine to defend itself. I mean, we need to work with that. We don't have any guarantees from Russia's side that they are intending to keep those agreements. But of course, right now, the ball is in Russia's court to show goodwill. They could start with, giving back the children that have been deported to Russia. They could start with releasing the prisoners of war. They could start with many elements to show their goodwill, really.
You said from the get-go that Europe had to have a seat at the table for these conversations about a deal. Are you being briefed regularly? Do you feel involved in this process? Are you satisfactorily involved with how it's playing out?
Well, any deal without us can't just simply work, because the war is in European soil, and it needs Ukraine and also Europe to agree to any kind of conditions that we have to implement, or any kind of deal that we have to implement. That gives us the seat around the table.
That's European Commission Vice President Kaja speaking with Bloomberg on the sidelines of a G7 meeting in Canada. Now, if you're a Bloomberg subscriber, you can catch up with all our interviews by using our interactive function, TV Go. You can also join the conversation by sending instant messages to our team and our guests during our live shows. You can check it out at TV Go. Plenty more ahead. This is Bloomberg. Chinese startup Manus AI has created an artificial intelligence agent that has gone viral and impressed many with its capabilities. Bloomberg opinion columnist Thorbecke says the tool reveals Chinese startups can also compete with big US tech firms in building AI products. She joins us now from Tokyo. So, Catherine, Manus AI is drawing a lot of comparisons to DeepSeek, but it is different, and this moment's different too. Can you tell us how?
Right. So I think some of the comparisons to DeepSeek that we're seeing now are understandable, but there are some real key distinctions here. You know, the DeepSeek moment was really about technical breakthroughs, and DeepSeek released its own AI models, whereas Manus AI, I think, is really about product innovation. And it was built off of existing AI models, and Manus AI used sort of underlying technology from Alibaba and Thorbecke, from what we know, to sort of build this tool and build this agent. And I think it shows that Chinese startups are really becoming very competitive in sort of the consumer and business market and releasing products that can actually compete toe-to-toe with the offerings from Silicon Valley right now.
Catherine, I mean, there's been an enormous amount of hype about Manus, but yet it has been actually pretty difficult for people to access the tool. What has your experience been using it?
Right. So, I wrote in my column that getting access to this tool felt like scoring Beyonce tickets. I mean, it was just, there was so much global hype, and it was very, very difficult to do, trying to find this access code. And, when I went in there, I do think it was still sort of imperfect and very glitchy. But at the same time, I was very impressed. I asked it to build me a personal website, and within roughly half an hour, it fully deployed a temporary URL that had a bio page, a contact page, pretty much everything that I had just asked for in a very quick prompt. And it was able to do that all on its own. I didn't have to, jump in at any stage. There were other times where I found it a little bit slow, but I think that the interface is very, very user-friendly. For an AI agent, it really runs you through every step of the process, every step that it's taking, and allows you to sort of intervene at any time if you need to. So I think, it's still obviously in beta mode, which the company acknowledges, but I think it showed a lot of promise, and I was very impressed by it.
So there's some lessons here for Silicon Valley.
Right. So I think sort of the unleashing of these AI agents, from Silicon Valley and beyond, I think we do need to start having broader conversations about how much autonomy we really want to be giving these AI tools. But at the same time, I think we've seen, in Silicon Valley and the large sort of AI labs have really been chasing artificial general intelligence and trying to create AI tools that are, at the PhD level or smarter than humans. And I think what Manus AI has shown is there's some really practical applications that can be used by these AI tools now that can really help consumers. And another thing I think we're seeing is that what Manus did was really sort of take underlying AI technology and sort of turn that into more of a commodity. And the really selling point of it is, the services and the applications that it's built on top of it. And I think that's a theme that we're going to start seeing playing out more in Silicon Valley and beyond.
That's Bloomberg's Catherine Thorbecke there in Tokyo for us on the score that was just like winning Beyonce tickets. And elsewhere, here are some of the other top corporate stories that we are following this morning. Alibaba has unveiled a new version of its AI assistant mobile app, Quark, which incorporates its latest in-house reasoning model. It now integrates functions including a chat box and a task execution. New Quark will be available to all users gradually, starting with a pilot launched on Thursday. World Liberty Financial, one of the Trump family's crypto ventures, is said to be in discussions with Binance about doing business. Sources say conversations have included the development of a stable coin with World Liberty. According to its founding documents, the Trumps received 3/4 of the venture's net revenue. Tesla has warned the US government that retaliatory moves by other countries could drive up costs and make its cars less competitive. It expressed concern about tariffs' impacts on its supply chain. And in fact, Canada's third most populous province, British Columbia, pulled government subsidies for people to install Tesla chargers. BC Premier David Eby said the move is targeted at Tesla CEO Elon Musk, who is one of Trump's biggest backers. Bloomberg has learnt the operator of retailer Forever 21 is preparing to potentially close down its stores as part of a bankruptcy filing in the coming days. Sources say efforts to find a buyer for the fast fashion retailer to avoid a liquidation have failed so far, but talks with one potential bidder are ongoing. At its height, Forever 21 operated over 500 locations in the US and at least 800 worldwide.
All right, let's take a look at how markets are tracking on a day when we saw the S&P 500 slipping into correction in the US. It's risk on the other side of the Pacific Ocean. Take a look at the CSI 300, better by 1.7%. That is enjoying its biggest jump in 2 months now. but the love being spread around those major Chinese markets there. The Shanghai Composite up better by 1%. The Hang Seng in Hong Kong better by almost 1.4%, and that has snapped a 5-day losing streak for the Hang Seng. So it's having a good rebound heading into Friday. Let's take a look at a few stock-specific stories as well. We are seeing Baidu shares gaining pretty handsomely as well, better by 3.8% in Hong Kong. Now, this is on a report of cooperation with Tesla. This is a Reuters report saying Tesla is working with Baidu to improve its ADAS system in China. And Baidu has sent engineers from its mapping team to Tesla's Beijing office in recent weeks as well. That's citing two people familiar with the matter. Tesla suppliers performing well there. And CATL, ahead of what we are expecting could be record profit when we get full-year earnings later on Friday. The world's biggest battery maker posting a rise there of a bit better than 2.3%. So we are holding firm for those results coming in a few hours' time. I want to take a look at another stock as well. That is CK Hutchison, being on a bit of a wild ride right now. We're seeing it sinking about 6%. This is after earning a rebuke for selling its Panama port stake potentially to BlackRock. Ta Kung Pao newspaper accusing Li Ka-shing of spineless groveling, selling out the Chinese people. That stock was still up more than 20% on the day that deal was announced. More ahead. This is Bloomberg. All right, it's 11:29 Friday morning in Tokyo. We've got Japanese markets going on a break shortly for lunch, but also a positive session there in Japan. We got the Nikkei better by about 1/3%. The Topix also pushing higher by 0.4%. The yen has been weakening a little this week, currently hovering around that 148.25 level. We're also keeping an eye on Japan's largest trade union federation. That says it's set to announce its initial tally of pay deals as we head into that crucial Shunto wage negotiation season. It's going to give us an insight into wage growth momentum in Japan. But Japanese stocks pushing higher at the moment. Rebecca.
Thanks, Paul. Yes, and shifting gears. All right, we are focusing on China's CATL as the world's largest maker of EV batteries. It's preparing to release those earnings later today. Analysts are overwhelmingly positive on the stock, even as trade tensions between China and the US, of course, are threatening to reshape, and in fact already are reshaping that global supply chain. Let's bring in China Great Wall Securities EV and lithium-ion battery analyst Yuan Mei, who has an ad rating on the stock. Let's begin with CATL. We have these earnings coming through today. What are some of the highlights that we should be looking for, and what are these key metrics that will give us real insights into the outlook for the business?
As we just mentioned, the tariffs between China and the US, maybe there are tariffs between China and the EU. So I would like to suggest the audience today to pay more attention to how much they earn from the overseas. Just like we can see from the past earnings report that ever since 2022, the company just got more money, got more revenue from the overseas, and partially because there is a war between Ukraine and Russia. And that part is not about the EV battery. It's about the energy storage battery. When we come to the EV battery, because the automotive industry is so important nowadays, so actually the overseas government gave Chinese battery companies more tariffs on that part. And I want to clarify that they are totally two different things. And when we come to the case in the U.S. between U.S. and China, we can see after Trump become the new president, he gave us more and more tariffs. And it become a trend that everybody tax everybody and everybody tax back everybody. So nowadays, for the tariffs alone for the EV battery, it's as high as almost 15%. And for the energy storage battery, it's also about 30%. So in the long term, it will be impossible for Chinese battery factory to manufacture the batteries in China and then send them to US. So that's a real problem. So for that earning forecast, that's one important thing. And another important thing I want to ask to understand that the revenue is falling.
Right, yes, yeah. So this is a really important dynamic. In fact, I just wanted to ask you on. We have this interesting dynamic. They're going to achieve, at least analysts expect, record profits on the one hand, but annual sales are a miss. It's a really unique dynamic that we haven't seen before. Just explain why and what that tells us about what's going on at the company.
If we take a closer look at the figures, we can see that the decrease is less than 10%, while the increase is more than 10%. That's why we should pay attention to that part, which means that the revenue capability of the company is improving. Mainly, I guess there are two reasons. One reason, just like the company said, because the falling price of the raw materials, so they can give cheaper price for their final clients. And for me, I have another opinion about the outcome, because I think the companies wisely, they run away from the low-end market.
Right.
Yeah. And as you can know, there is a price war in the Chinese EV market. Yeah, so the cars become cheaper and cheaper. When the car becomes cheaper and cheaper, they only give lower and lower price to the EV battery company. So the leading company may refuse to join the game. They want to keep the quality, they want to keep the price.
And there are important dynamics here to just about that broader landscape. We've seen demand for EVs overseas falling. We've seen these really rapacious price wars. We've also had this dynamic of some of CATL rivals faltering. Into that whole environment, how does tariff have an impact? And where are we going to see the most pain points when it comes to tariffs? I just note, we have a story today, for example, Tesla warning the Trump administration that these tariffs and the retaliatory tariffs are going to hit the sector hard.
Yeah, just for the Tesla case, if we review the past quarterly financial reports published by Tesla themselves, you can see they always complaining how hard to ramping up the production of the EV battery, especially the one they want to make it more make more efficient in the use of energy, because they don't have that kind of technology to make it possible. It's like it's one thing to invent a battery, it's another thing to make the new battery can be produced in massive way.
Right, yeah. That question of scale there.
Yeah.
Yeah. Okay, so shifting to think about sort of global context here, what is the outlook and how are these companies positioned for the next 12 months? Are we expecting to see more consolidation? What are these key trends that we should be looking for now?
I think for the EV part, we should, because we have many data nowadays, and if we look at a global picture, it's like the top 2 Chinese battery company dominates half of the world. It seems very strong. But if we took out Chinese market away from the picture, we will say that still Korean and Japanese companies, they dominate more than half of the market share. Why? The reason still lies in the facts we talked about the EV market in China. We have huge demand, so Chinese battery receive huge opportunities to product that much, as many as batteries. But for the Korean and Japanese companies, they have more overseas market. Yeah.
Great, May, thank you so much. It's a pleasure to have you with us today. That's China Great Wall Securities EV and lithium-ion battery analyst May with us. There's plenty more ahead. Stay with us. You're watching The China Show. This is Bloomberg. Good morning. You're watching The China Show. Time now for trending in China. So Hong Kong tycoon Li Ka-shing's CK Hutchison is in the spotlight after its deal to sell a controlling stake in Panama ports to BlackRock. It's become the subject of a scathing piece in the pro-Beijing newspaper Ta Kung Pao, which was then reposted by China's top office on Hong Kong issues. The commentary itself accuses CK Hutchison of spineless grovelling, that's a quote, and, quote, selling out all Chinese people, warning it to, and again, a quote, think carefully about what position and side they should be on. It also points out that China's shipping and trade could become subject to US control. China's Hong Kong and Macau Affairs Office shared the article in full on its website, fueling speculation that it also reflects the central government's own sentiment. Bloomberg opinion columnist Shuli is with us. Shuli, your reaction to this?
I think it really was a scathing commentary, if you read through it. And I think I can see why China is kind of pissed off, because it's no secret that CK has been wanting to sell its port business over the years. And all of a sudden, there's a push factor coming from Trump. And I can see that the government is not too happy about that.
So you've also written, well, I know across your work you've written extensively about Li Ka-shing, but recently about the reputation that he has as a sort of so-called Superman.
Yes.
You take a slightly different view. Why is that?
Well, he is nicknamed Superman in Hong Kong, and people do look at his, M&A merger and acquisition moves to see what his true views are about China and the rest of the world. But in terms of shareholder returns, the Li family has not treated Hong Kong's shareholders well at all. If you look at the CK Hutchison, their holding company's shares, Hong Kong, right? Over the last 10 years, this stock is basically in the doghouse, right? Like 10 years ago, it was traded at 1 times book. Now it's 0.3 times. The Li family basically didn't really get the Hong Kong residents enjoy their business acumen and prosperity.
So that being the case, what can the Li family do to make amends with Hong Kong people, improve their reputation?
I think it's probably the 96-year-old's last chance to make amends, right? And the one thing they could do is to improve shareholder returns. They got the $19 billion from the port deal. And to be honest, the Chinese government, there's not much Chinese government can do about it. It's pretty much a done deal, right? And what are they going to do with that $19 billion? $5 billion will probably be used to repay debt. And the rest, they can issue shareholder buybacks or special dividends. I mean, if you look at the other Hong Kong listed companies, Alibaba, Tencent, when their share prices were not doing well, they were trying to reward shareholders with buybacks. And the Li family has not done so at all.
OK, that's Bloomberg opinion columnist Shuli there. Paul, back to you.
Yeah, let's get to another stock that we're tracking today. AIA says it's starting a $1.6 billion share buyback. This after reporting 17% growth in new business value last year. Group CFO Garth Jones spoke with us earlier.
Yeah, we saw an excellent set of results by any measure in 2024. We saw double-digit growth in our key metrics for new business growth, for earnings, and for cash generation. Our value of new business, our key growth measure, grew by 18%. And importantly, we had double-digit growth across all our market segments. It's a broad-based growth. Our operating profit after tax was up 12% per share, and our underlying free surplus generation also grew by double digits.
Bloomberg Intelligence lead insurance analyst for APAC, Stephen Lam, is with us now. Stephen, let's kick off. What were some of the highlights from earnings from 2024? And particularly, what were you looking out for in that second half? What caught your eye?
Yeah, Rebecca, so I think the key highlight definitely is the $1.6 billion buyback. I think it goes to show that it is very consistent in terms of the shareholder return. And I think if we sort of peel over the onions a little bit, within that 1.6, actually 1 billion is actually an incremental increase. So based on their shareholder return policy, they only needed to do, say, 0.6, but they give an extra 1 billion. Now, versus our expectation, we were expecting a little bit more, maybe $2 billion for the extra. So I think the implied message here is that, in our understanding, is there could be potential for some M&A or a pickup in terms of organic investments.
And in terms of the broader earnings outside of that 1.6, what were some of sort of the positive and the negative surprises that we saw?
Yeah, so I think the margin expansion is definitely continuing, so that's a good thing. That's driven by a mixture of product mix and also repricing, especially in China, so that was good. If we were going to pick on it, I think the slowdown in the fourth quarter is something that is a little bit on the lower end, weaker, but that's mainly driven by China. And the reason being is both an impact from a high base and as well as a strategic product sort of movement away from the guarantee products and preparing themselves for selling more participating policies.
So is China's low bond yield a concern while the insurers are growing so rapidly there?
Yeah, Paul, so like I said earlier, so the fourth quarter is a very tricky part. We saw that over the past 6 months or so, the bond yield really punched in China. And because of that, I think the insurance companies really need to relook at their product strategy. And for AIA, I think they've decided to really move out of the short-term savings products and into the longer-term participating policy products. So that is one way to help them shield themselves from these interest rate volatilities. It is hurting the life insurance industry as a whole. But I think the point is that how long this low bond yield will be there for China. So if the economic growth picks up a little bit and if sentiment improves a little bit and hopefully we get some inflation coming back, bond yields may be able to recover from that on.
All right, Bloomberg Intelligence lead insurance analyst for Asia Pacific, Stephen Lam there. Well, this weekend, the new Formula One season gets underway in Melbourne with the traditional opener, the Australian Grand Prix. This is not an easy sport for new teams to break into, but there's one Aussie tech CEO trying to do just that from a remote mountain base in New Zealand. The scenery is stunning and so are the cars that shatter the piece. There's no neighbours to complain about the noise here at Mount Lyford. This is where the CEO of ASX-listed Dicker Data set up Roden Cars, a very expensive passion project.
I wouldn't say building cars is necessarily the most profitable business in the world, even if you can be successful.
In 2005, Dicker bought a 1,300-acre farm here and, over time, built a test track and a garage with all the gadgets, including a 3D titanium printer and electrical engineering equipment. The F-Zero hypercar is one of the results. A 4-litre V10 engine, a top speed of 360 kilometres per hour, and a no-rules design philosophy. It looks like something Batman would own.
Well, on the F-Zero, we designed the whole car ourselves, basically. I designed the car completely from scratch. So there's, other than, electrical components and, brake systems and a few other bits and pieces, virtually everything on the car we made here.
Another of Roden's cars is the FZ, which looks more similar to a Formula One car. It was hoped Roden would be on the grid for this year's Formula One season, the first team ever from the Southern Hemisphere, turbocharging production and innovation at Roden's base. But the bid was unsuccessful, a failure that Dicker blames on Formula One politics.
They're not really interested in sporting teams, they're interested in big corporates that can use the sporting side of it as a marketing function. And that's not really sport.
Dicker is refusing to give up on his F1 dream. He admits it's unlikely, but then again, the entire Roden story so far has been unlikely.
Good morning and welcome back. You're watching The China Show. A very happy Friday to you. All right. Portugal will hold an early election on May 18th after the government was ousted in a confident vote. The collapse may delay some key decisions, including infrastructure, investment and defence spending. This will be the country's third election in just 3 years. Prime Minister Luis Montenegro is expected to seek re-election. US Senate Democratic leader Chuck Schumer is dropping his threat to block a Republican spending bill. The move opens the way to avoid a US government shutdown on Saturday. Democrats and Republicans have been engaged in a standoff over Democratic insistence that a spending package includes some restraints on Elon Musk's federal cost-cutting crusade. And staying with the US, where Commerce Secretary Howard Lutnick is praising the UK and Mexico for refraining against engaging in tit-for-tat tariff hikes with Washington. Speaking with Bloomberg, he blasted Canada's retaliatory tariff moves, accusing the government of doing it out of domestic political interests. Just take a listen.
Take a step back. National security, we put a tariff on steel and aluminum to make sure the dumping countries of the world stop and we can build up our steel and aluminum in America. And what does Canada do? They put a tariff on sports equipment. I mean, really, this is just, it's tone deaf. Listen to the president. National security matters when he calls out things like semiconductors. He calls out pharmaceuticals. He calls out autos. These are things that matter to us as a country. And if you're going to respond to us with sports equipment, you're just not listening to President Trump.
Secretary Lutnick, how much are the conversations today actually about bringing up the negotiations when it comes to USMCA?
Well, USMCA, we set aside USMCA. So the United States made a deal with both Mexico and Canada that said if you have enough U.S. content in certain products or it's actually made domestically, they can trade between our countries tax-free. That remains intact. What is outside of that is both things that don't have that American content that are imported from other countries. So that has a tariff on it. And now the president has said, look, there are certain topics I need to have us make in America. And steel and aluminum is key. I mean, we all understand that. So why not allow the greatest country in the world, who completely feeds Canada? Canada exists, completely feeds off of the amazing economy of the United States of America. Let us build up our steel and aluminum so that we can protect ourselves. And by the way, we protect Canada. I think Canada's got 60 planes. Oh yeah, they're really going to protect themselves. They're the lowest investor in NATO. They totally rely on us, and yet they think they need to respond to steel and aluminum tariffs. I mean, everybody is so used to picking off America, so used to it that they can't even stop. Donald Trump is here to say we need to be treated fairly, and we need to be treated fairly now.
That's US Commerce Secretary Howard Lutnick speaking with Bloomberg's Anne-Marie Auden. OK, let's take a look at how markets are tracking in Hong Kong and China at the moment. We're keeping an eye on consumption stocks. This is the best performing sector on the Hang Seng at the moment. And the Hang Seng itself just continues to build on gains. That index now better by 1.75%. So you see some of the key consumer stocks there. This has been the biggest gains we've seen since early February. Consumer shares leading those gains amid, of course, expectations that came out of the MPC on the expectation of more policies to boost that sector. So we're going to have a press conference later on today from the central bank and also a number of other government bodies regarding boosting consumption further. All right, taking a look also at BOC Aviation shares. They are also surging, better by 4.6% at the moment in Hong Kong. Those shares gaining after the company reported a record net profit after tax, $924 million for 2024. That's up 21% on last year, Rebecca.
Yes, and just noting before we close out, southbound flows actually very, very low so far today, 1.2 billion. That compares to about 11 billion for your 20-day average. We've really flip-flopped through this week. Earlier, we had southbound flows had their second best day on record. They were very, very low yesterday. Let's see how we close out today. You've been watching The China Show. That's it from us. A very good morning to you.